Welcome, everybody, to the June market update featuring the expertise of the one and only Mike Ott. I'm Cindy Bishop with Cindy Bishop Worldwide. Our distinguished speaker, Mike Ott, brings a wealth of experience to the table with a background as a former public school teacher and an impressive double-digit tenure in the mortgage industry. Mike has earned a stellar reputation. I love how he is. He's steady and dedicated and no getting excited about anything. I like that, especially in his line of work. His unique educational approach and unwavering commitment to excellence have endeared him both to clients and agents alike. Mike's profound understanding of the intricate nuances of the market, coupled with his unparalleled attention to detail, make this market update an indispensable resource for agents seeking to stay ahead of the curve. I especially like the fact that we have this market update a little later in the month because Mike actually waits for all of the right reports to come out to be up to the date. So I really like that. It's not just a conversation, it's actually facts. And I do think you all need to have that. As a senior home loan consultant at First Heritage Mortgage, Mike is well versed in the intricacies of the industry. Additionally, his status with us as a sought after trainer further underscores his expertise. Please join me in extending a warm welcome to our presenter today, the one and only Mike Ott.
Thank you, Cindy. Good afternoon, everybody. All right, June, the midway point. We've made it this far. All right, so let's start where we start. Let's look at rates across the products, the loan types. Conventional conforming, we're seeing 6 3/4 to 7 1/4, give or take borrower profile, whether or not borrowers, paying some discount points or not. I think the national average is 6.8 and some change right now currently. When we move into the high balance and the jumbo, that span of rates is always typically a little bit higher than your conforming loan amounts. So we're at 7 to 7.5 there. And there might be an opportunity here and there across investors where you're sub 7, maybe as low as 6 3/4 on any given day in that jumbo high balance space. Government loan products, VA, FHA, and USD rural housing, all pretty much kind of in the same range. Might be able to do maybe a quarter lower in that range on VA, give or take the day in the market conditions. I always plug mortgagenewsdaily.com. It's a great place you can go. You don't have to subscribe or pay anything, and you can just see how they track the national average across these loan products. All right, mortgage-backed securities, our candlestick chart. So we've got pretty much in a channel here. And I put a dark horizontal line there across the top of the channel, and the bottom line, I didn't make that bold or big enough, but that it's kind of there where those candlesticks kind of bottom out. You can see we're just in this range, and we have been. We saw probably some of the best interest rate pricing tail end of March, first few days of April, and then all the tariff stuff started. And we've been trapped kind of in this range, oscillating. But even in the movements that you see here, it may look major or dramatic, but really it's 1/4%, maybe no more than 3/8% in movement when we have some of these big sways up or down. I highlight the June 6th BLS jobs report. That came out again stronger than expectations. Those of you that have been tuning into these market updates know that I'm a little bit sour on the BLS and their method of data collection. It's seems to me pretty unreliable and lacks some validity, and it's usually so far disconnected from the labor and economic reports that we get out just prior to when the jobs report comes out from BLS. And that's mainly JOLTS job openings and then the ADP employment report. They're usually so stark in contrast in the data set that's resulting from these. And there's a huge disconnect between a lot of the labor and economic reports and the BLS jobs report. And we got another, doozy. And again, the market trades on the headline. That was a big dropping red candlestick for us on the 6th. We kind of battled back a little bit, but you see we're in tiny little bit of a downward trend in the last couple of days, but we're, trying to find some footing and stay above that 50-day moving average there, which is that black squiggly line that you see going across the chart. So it'd be interesting, Cindy mentioned that we like to time these after a majority of the economic news is out. We just so happen to, schedule today when tomorrow is actually the Federal Reserve meeting and the interest rate decision. There's pretty much a zero chance of any reduction in the federal funds rate tomorrow. Everybody will be listening to Chair Powell's comments in the post-announcement press conference that starts at 2:30. That's usually where things are going to go wonky and the markets are going to get a bit jumpy. It's usually during that question and answer session. But if we look back since the last time we met, we did get April personal consumption expenditures. That's the inflation data that the Fed loves to pay attention to. That came out on May 30th. But you gotta remember it's reporting the data from the month prior. So it's an April PCE reading. Next week, we will get PCE for May, and we'll be talking about that next month. But in April, headline PCE was increased 0.1% in line with expectations and decreased 0.2% to 2.1 year over year, just below estimates at 2.2. As a rather tame inflation report. When we look at the core, which strips out food and energy, that increased by 0.1% month over month and decreased 0.2 to 2.5 year over year, also matching expectations. So there was no harm done, nothing there to hurt interest rates. That was, again, meeting or beating expectations is good on these inflation reports as we move forward. Now, May ADP employment report came out on June 4th. That showed only an increase of 37,000 jobs in the private sector in May, which was well below the expectations of 115,000. Previous month's figure was revised lower to 62,000, or from 62,000 to 60,000. So, I mean, we're talking about that private sector. That's real low. That's way below expectations, and arguably a more realistic look of the labor and employment market. April JOLTS report came out on the 3rd of June. And now that was a little bit surprising. So I put that one in red. That's not great news to see all these openings, but it rose 191,000 to 7.39 million, which was almost 200,000 higher than estimates. So that was a real shock. What contributed to that? The problem is, well, our problem in real estate mortgage is that the jobs that are created, a vast majority of those, most of them are in the healthcare field. Two highlights or lowlights, if depending on how you might look at it in that report, are that the jobs that are being posted, they're part-time jobs. All right, and anybody that's just on part-time work alone, we know that they're not the ones out there that are making the economy churn. They're not buying cars and houses. What they're trying to do is make rent, and pay, put food on the table. So it's a little misleading with so many part-time employment jobs. And then the leisure and hospitality industry, which has been kind of post-COVID, been obviously exploding with everybody being back to work over the last few years. And we are now, kind of at that pre-COVID level of the leisure and hospitality employment sector. And it actually decreased a little bit. So, that means we're seeing some layoffs in leisure and hospitality as well. And it's natural, right? People are cutting back on spending, they're cutting back on vacationing. We've got record all-time consumer debt, delinquencies on credit cards, auto loan defaults. So, it was only a matter of time if we're not seeing people pay those important expenses each month that, they're going to have to tighten the budget belt, and they're not going to be, spending And, you know, they're gonna have to put money towards these critical debts that they have, like a car loan, or, you know, rent or housing payment. So, you know, we have a Fed that last time they met, you know, in early May, was feeding us a line that the economy is on solid ground. If you listen to any of the economists out there, um, you know, they're all saying the same thing, that the Fed is, you know, putting this word out. I'm not even convinced. I don't think they believe what they're saying personally. And there's a lot of people upset with the politicking that's going on between the administration and the Federal Reserve. It's all over the media, you know, with the pressure on Powell and the Fed to reduce rates. The reality is that some people, some economists believe that, you know, tomorrow's meeting, we're not going to have them. We probably should have had a 0.25% decrease in May and another 0.25% tomorrow. But they're digging their heels in. Arguable, you know, it's arguable whether it's the Fed, you know, playing politics, and just trying to do this out of spite. Problem is, it seems that way. Economists are talking about it that way. And it shouldn't be that way, right? The Fed is supposed to be a non-political, bipartisan. Hey, we're here to serve all of you know, the entire population of the United States, and have our dual mandate of maximum employment price stability. And their decisions as of late to hold rates in this extremely conservative fashion seem to be contrary to what the Fed's dual mandate really is. So it'll be interesting to see. I'll be tuned in tomorrow at 2:30 for the question and answer. I noticed that if you've ever watched any of those, you'll notice that it's the same press people. And to keep that privilege of being able to be in there, they have to, I have to believe that they're asking rather tame questions. Some of them tiptoe up to the line, but really what I think is needed is some very aggressive questioning of the Fed. But I don't think we're going to see it by the national media, because they don't want to be disqualified from attending those meetings in the future. But we need some answers, I think, and I don't know if we're going to really get a clear-cut answer tomorrow. So it'll be interesting. All right, the May BLS jobs report, like I said, came in stronger than expected. Market was expecting 130,000, came in 9,000 over. Employment gains of March and April were obviously revised lower by a combined 95,000. The unemployment rate, by a decimal rounding, actually stayed at 4.2%. It's on the heels of 4.3%. You know, so we'll have to wait and see at the end of this month. With our weekly jobless claims being steady to increasing as well, we'll have to see if there's an uptick in the unemployment rate when we get the June reading in early July. Average weekly earnings were up 0.4% for the month, up 3.9% year over year. Again, you know, the earnings are up, but the hours worked are down. The average hours worked are like 34. So we're not even anywhere near a full-time working hours at 40 hours per week. So it'll be interesting. The BLS continues to kind of disappoint. Their modeling is poor, and now there's talk that they're understaffed due to, you know, some of the federal layoffs. So they there was a Wall Street Journal article where they pretty much admitted that, hey, we're just guessing at some of this stuff. Don't know whether the market's really paying attention to that, because they seem to trade hard on this higher than expected number on June 6th. And as we saw from the candlestick chart, it hurt the bond market, it hurt mortgage-backed securities, and therefore hurt interest rates and the pricing that can be offered to consumers. The latest inflation report was last week. We did get the consumer price index. That's the other inflation reading. It increased by 0.1% month over month. That was better than expectations of 0.2%, increased 0.1 to 2.4 year over year. That was lower than the estimated 2.5. So again, we're getting good inflation readings. The core CPI rate, which strips out food and energy prices, increased by 0.1% in May, and that was below the expectations of 23. Remember, that's the core, right? So core is more closely watched than the headline number. It remained at 2.8 year over year, lower than they were expecting it to creep up to 2.9. So again, a favorable inflation reading. And that was thought to have been the first inflation reading that we see where the impacts of tariffs might be felt. And it was a no-show, it was non-existent. So the mentality now is, oh, will we see it, in the CPI report that we get in July from June? That question remains. And as we mentioned, Fed rate decision tomorrow at 2 o'clock. The expectation is that they will not, they will hold rates steady. And the consensus is that we also will not see any movement in July, that the first chance of a rate cut would be at the September meeting. A lot of economists and I also feel that I think that's going to be a little behind the curve and perhaps a little too late, but we have to see how this plays out. Any questions on the market news? There was chat. Mike, do you have statistics on short sales? I do not. Yeah, good one. Sorry, I do not have any short sale data. We will hear of foreclosures, but nothing. The last time I heard a foreclosure report, I don't even remember the numbers, but it was nothing alarming. But yeah, I don't have any specific data on short sales. All right. We always look at the CPI chart. It was nice that the highlight here is that the shelter component, which is the heaviest weighted one. So remember, it looks at rent, but again, it's looking at rent in a rear view mirror. And that OER is owner's equivalent rent. That is a telephone survey. They call households and say, hey, if you were to rent your house unfurnished, what would you rent it for? And remember, this is just people, they have most homeowners have no concept of what the rental market is like in their neck of the woods. They could be throwing out these ridiculously high, unrealistic numbers. So again, the modeling is flawed. Lodging away from home, that is your hotels and your Airbnb, but notice, I mean, those are negative. That's always the wild card too. As we get in now to June, July, August, summer months, will we see an uptick there with people that, are still doing vacations and traveling during summer vacation? Will we see a peak in hotel? I wouldn't be surprised if we see that number increase. Just hope that it's tame if so, but to see the decrease finally in shelter that we've talked about, there's going to be such a lag in this indicator. And we're still seeing it lagging because real-time rents on a national level are down in most of the major markets. Some markets are always going to be a little bit different. Our DC metro area could be different from the norm as well, but across the board, across the national averages, real-time rents are down. These apartment complexes, there's talk of them offering super incentives, 2 months rent-free, 3 months rent-free, just to get these vacancies filled. So again, that's a sign that the rent prices are definitely coming down, especially if you have new apartment complexes trying to entice people to come and rent with offers like that. Used cars and trucks, new cars and motor vehicle insurance, all relatively tame. Remember, motor vehicle insurance has been a pain for us in the past, but nothing out of the ordinary there, nothing unexpected. But everything else core, I mean, at 0.04, that's why economists are sitting there knocking on the door saying, hello, Fed, you've squished the inflation, you've done your job. And now we're starting to see cracks in the labor market that they're not really acknowledging. Again, because they're looking backwards, they're not paying attention to the real-time reports. So interesting that the core CPI, if you took out the, if you factor in the shelter lag, the core would be at 1.7, right, and not 2.8. That's well below the Fed's target of 2%. They like to see. So, inflation. I expect what we'll hear tomorrow. I expect them to press him a little bit about, hey, we've had really tame PCE and CPI. Why not lower rates now? I think they'll ask that in a very tame, polite way. I would expect that he's probably going to continue to push back and say that, we still don't know what to expect from the potential of tariffs, down the road. I think that's going to be his stock answer, if I had to bet. I don't like the answer. I don't think it's has merit right now, because you could lower rates right now, and then if the tariffs do cause a bump in inflation, what's to say that you couldn't pull back, at a meeting and increase rates a quarter? So again, right now we're not seeing it. So I think they're going to answer, and they're going to continue to take this wait and see approach. And I think it's going to keep us stuck in terms of mortgage rates. I think it's going to keep us stuck in that channel that we saw back on the chart. All right, local real estate. Northern Virginia area, median price 789.5, up 3.9% year over year. Total sales down 4.2% year over year. Prince William median price 589,000. That's up 1.8% year over year. Total sales down 2.7. The Dulles area, again, I don't know, they always put their numbers out like these are April numbers for Dulles area. Median price 819,965. That's up 5.4%. That definitely shows you, that the appreciation is still occurring in that predominantly Loudoun County area. Total sales up 7.3% in April. Be interesting when we get their May numbers. What do they look like? I do think there's probably a case that they'll be strong in comparison to these Northern Virginia and Pennsylvania numbers that we see. All right, lending stuff. I left this on here. I know last couple of meetings we talked about. Keep in mind, FHA and USDA government loan products have now eliminated eligibility for non-permanent resident alien borrowers. So that's someone who's here legally, but only on work permit visa status. So to be eligible for FHA, you either need to be a U.S. citizen or a green card holder. And I keep that on there because, again, I've already had 2 or 3 applicants since the May 25th deadline there that have applied, and where their credit is such is that credit-wise, they could only do an FHA, and now they can't do it. So I do think it's, I think to me, it's a negative. I think we're going to see that's going to put a little bit of a ding in that home buyer population for sure. How big it will be remains to be seen. Virginia Housing has that first home dream program that I told you about last month, a 2% reduction in interest rate. Must be first-time buyer. Borrower and any spouse also has to be, co-borrower has to be first-time buyer. And the program here is that you have to be a first-generation home buyer, meaning you have to sign an affidavit that, hey, your parents have not owned a home in the past 3 years, right? And it's all a Virginia Housing program. They have to do the bond programs. They cannot do any of the Virginia Housing standard programs. It's got to be one of the bond first-time homebuyer options. They can still look at doing the grant and the plus second mortgage program. However, they cannot, this reduction in interest rate cannot be used in conjunction with the Spark Fund's 1% reduction rate. So I don't want anybody thinking, oh, they could do, a first generation buyer could get 3% lower in rate if they use Spark. They will not allow it. But that's, you know, when you're out there talking with your buyers, and especially if you've got the uh, uh, younger first-time home buyers, you know, ask the question, you know, hey, I mean, or you guys are first-time home buyers, but how about family members? Do your parents own the home here, you know, in the United States? Because if not, this might be a good topic for you to bring up and say, hey, you know, when you talk with the lender, be sure and ask about this and see if they have if they offer the program. This was the example, right? Hey, if the market rate's at 7% on a $235,000 loan with the first home dream, 2% reduction. I mean, we're talking about a $302 a month savings and payment. You know, 3623 per year, and over the life of a 30-year loan, 108,695 less money out the door. So it could be pretty impactful. I don't get too caught up into that 30-year loan. Most people aren't in a mortgage loan for the entire time, but the most first-time buyers are about month-to-month budget, and $302 a month difference on a mortgage payment is significant, without a doubt. And you know, I bring this buyer mistake slide back. We seem to be arguably, you know, maybe somewhat slower spring and summer market so far. Rates still stubbornly high. But read a lot of articles lately about new home builders are killing it. Well, they're killing it because they're offering buy downs, 2-1 buy downs to clients, right? And they're footing the bill for it. Well, you know, if you put your listing agent hat on and you're working with sellers, you know, keep this in mind, that you and your sellers on the listing side can do the same things that the builders are. You have to build in a concession. Potentially, if you've got a house that's kind of sitting stagnant on the market, not getting much traction, you know, not getting the views that you would hope that, you know, the market's telling you something about price, right? Or we all know the dreaded curse, you know, that the longer the days on market, the buyer population out there is wondering, is there something wrong with it, and this and that, right? So our days on market's, you know, a big thing that we pay attention to. But having some conversations when you're on the listing side with your sellers about potentially offering a concession to do, you know, so that the buyer can do a 2-1 buy down on their mortgage. And this is what you know, the chart just shows you that, you know, in a 2-1 buy down, if the market rate's at 7%, then the buyer's payment on a 2-1 buy down would be based off a 5% rate in the first year and a 6% rate in the second year. And then years 3 through 30, the interest rate on the loan would go back to the note rate, which is 7. Now, keep in mind, buyers have to qualify at the higher note rate. But when you look at this chart, we're talking about what, a $406 savings per month to the buyer in the first year. You know, and what this chart does is if we move from left to right, on the left, you've got your standard 5% down conventional on a $333,333 sales price. The slide's titled Buyer Mistakes. Buyers think getting a deal is slashing away at a price, right? So that second column from the left is the buyer's mistake, going in, well, I'll offer 10,000 less. Well, the interest rate's still 7%, and even at $10,000 less, the buyer's only saving $65 a month, right? They'd be, you know, more apt and have maybe a better negotiating strategy of offer the list price, offer what it's listed at, but see if you can negotiate enough in a seller credit to where you could do the 2-1 buy down and have the reduced interest rates in year 1 and year 2 of the loan. That's what the builders are doing. So for those of you that are working with sellers, and if you've got, this might be, you know, even something to bring up when you meet for the listing presentation, right? Obviously, it depends on the area. There's some areas where you're doing a listing that they're still pretty hot and on fire and very much a seller's market. But I've seen, you know, some listings sit seen several price reductions. And again, when you're on the listing side, when you reduce the price $5,000-$10,000, look at columns 1 and 2 on the left-hand side. You're not moving the needle by dropping your price to entice buyers. So that $10,000 that you drop the price, or that the buyer lowballed an offer by 10 grand, that 10,000 in the seller credit would benefit a buyer much more so if that money was allocated towards doing a 2-1 buy down on the mortgage. So it's come back up in topic. A lot of it is surrounding the builders. The builders right now are doing very well, and this is exactly what they're doing. So if you're an agent working with sellers, why can't you do the same? Right? Entice buyers in, build in a credit, market the property with a credit for a 2-1 buy. All right, we got a couple questions here. Susan tried to take pictures, left the Zoom. Susan, yeah, I don't know if you came back on. Oh, you're there. Yeah, slide. I'll be emailing the slides out to you guys. Christine, question: are reverse mortgages popular today, especially with seniors? I have no idea. And you're like, wait, you're the lender. What do you mean you don't know? In my time in the mortgage industry, I've worked with one company where we had access to doing reverse mortgages, and it was fleeting at best. It didn't last. I do not have reverse mortgage expertise. That is not in my wheelhouse as a loan originator. First Heritage, we do not do reverse mortgages.
We have a lender that does them, Kelly Catalinas Fairway, and they're really excellent, but they only recommend FHA. They're the most protective.
Right.
I mean, they are the only choice, and I think they're fantastic, especially for keeping your money in the bank. Depending on how you're going to do it, how many houses do your kids need? It's a good strategy for your financial plan for some people. So there you have it. And we do have reverse mortgage classes, by the way.
Awesome. All right, guys. Any questions on anything? Remember, Fed meeting tomorrow. Our Fed meeting concludes tomorrow with the announcement at 2 and the press conference at 2:30.
They can email you then. You're going to send them the slides out today.
Yep.
Great. So they'll have all your contact information. That'll be fantastic because, not everybody's going to be on that call, but you will. So they can ask.
Yeah, they stream it live on the federalreserve.gov if anybody is interested.
It's an exciting hour?
Cross your fingers for dovish comments, not hawkish.
You all can only listen, right? You can't say anything or ask any questions, right?
What's that?
Is that just a listen only?
Oh, yeah.
Okay. Yeah. Wouldn't that make it fun?
Oh, that'd be a mess.
Real estate agents asking questions. Yes. All right. Well, thanks everybody. And thanks, Mike. And we'll see you in July. This is it for June.
Thanks, guys.
Take care. Thanks.
Thank you.
Bye.